Hello everyone and welcome back, options traders. I've seen a number of people talking about implied versus historic in our group here, and especially should I be comparing implied volatility to historic volatility or implied to implied? And what's the difference and why does it matter? Well, first of all, let's do a quick review of historic volatility. Remember, this is a record of the actual stock volatility. This is simply derived from a mathematical formula. There's no ifs, ands, or buts about it. There's no argument, no room for dispute. So if you come up with a historic volatility of 20% for a particular stock, then it should be the same at Schwab, Merrill Lynch, E-Trade, wherever, assuming we're looking at the same period of time. So it's just an actual mathematical calculation. Now, for those of you who have had statistics, it's a very slight variation on just a standard deviation. So you could actually download the historic stock prices from Yahoo and actually put it into Excel and find the historic volatility. So it's actually quite easy to do. But now there are some things that a lot of people don't understand about historic volatility, and this is something I always like to point out. Let's say that we have a $100 stock, and over the course of the year it does something like this. Lots of back and forth motions, not real high highs or low lows, but a lot of back and forth. But if we compare that to another $100 stock over the same year that does something like this, a lot of traders believe that this one in blue is going to have a higher volatility number because it's got lower lows and higher highs. Surprise, it's not. The one in red is going to have a higher volatility. So the concept of volatility, at least the historic volatility, is about this notion of back and forth. A lot of whipsawing and price changes. Remember that volatility is non-directional. So you could actually take a $100 stock, make it go up 10 cents a day or $1 a day, whatever, but something constant, and you would actually come up with about a zero volatility at the end of the year, even though you would have a very wide range of prices. All right, so what's the implied volatility? Well, this is the future volatility of that stock that is implied by the current market price. So we can look at an options price and say, just because traders are willing to pay $5 for this call option, what volatility are they implying must be expected from the stock? We're just working a pricing model backwards. Now that in itself sounds like a really complicated process. It's actually quite easy to understand conceptually, so let me give you a quick little analogy. Let's say that you're looking at buying a new car. And so here's a car loan calculator. So we put in some inputs, $25,000 car, 4% interest rates, and 60 months for the period of the loan. And we hit enter and it comes up with this price of $460 per month. This is the typical way that we work the calculator. Loan amount, interest rate, number of months, and it spits out the monthly cost. This is exactly how a Black-Scholes pricing model works. We put in some factors and it spits out the options price that you would expect to see. But I could work this backwards. I could say if I'm willing to spend $25,000 for a car over 60 months and I want to spend a maximum of $460, what interest rate should I be looking for? Or what's the interest rate that would equate to that $460? It's 4%. So here I've inputted the $25,000, the 60 months, and the $460 price, and I worked it backwards. And I said, what is the interest rate that is implied just by the fact that I'm willing to pay $460? So think about this. You walk into a car dealer, you say, yeah, I'm willing to take this $25,000 car, 60 months, at a payment of $460 a month. And he starts drawing up the paperwork, and you say, wait a minute, how did you fill in this 4% rate here? I never said anything about 4%. Well, he could say, well, you're implying that you're willing to pay 4% just by the fact that you're willing to pay $460. See, that's what it means to be implied. You didn't say it, but we can infer it just by the fact that you're willing to spend $460 a month. This is exactly what we're doing with a pricing model. So let's go to the CBOE's calculator and see how this works. So now we're at the CBOE, that's the Chicago Board Options Exchange's pricing model here. And let's just say that we have a $100 stock. We're looking at a $100 strike. There's 30 days to expiration. volatility, I don't know, we'll make it 30%, and we'll say that interest rates are 2%. And so if we put in these factors, we click calculate, it tells us that you should be willing to pay $3.51 for the call and $3.35 for the put. This is what's called the fair value. And that just simply means if you were to buy this option over and over hundreds of times under these conditions, you would just break even. And that's assuming that the stock is going to deliver 30% volatility over the next 30 days. Now, of course, we don't know that. But let's say for some reason there's maybe an earnings coming up, or some reason that we're going to expect this stock price to be more volatile. And therefore, the option traders are going to bid up this option's price. So instead of the $3.51 that we would expect, let's say it's trading for $5. Well, I can work the pricing model backwards. I can just type in down here $5 under the implied volatility calculator, choose calculate, and it's telling me that the market is implying that the future volatility is, let's just call it 43%. And what does that mean? It means if I put this number in over here, let's do it 43.05, and I choose calculate, then this number up here should become $5. And look at that, it did. So all we're saying is that if the market is willing to pay $5 for this call, then traders are implying that the future volatility of the stock will be 43%. Otherwise, they wouldn't have been willing to pay $5. So do you see how that works? All we're doing is we're working the pricing model backwards. We're saying I know this number, this number, this number, interest rates, and I know the market price, and we're trying to figure out what this number is. So now that we have this number, how do we use it? Well, there's a number of ways we can make comparisons, and some of them get quite detailed, but a very simple one is to just compare the option's implied volatility to the stock's historic volatility. And just ask yourself as a real simple level, does this seem reasonable? Now again, there's far more scientific ways of doing this, such as with vol cones or volatility cones, but just when you're starting out, just ask yourself if it at least sounds reasonable. So here's another little analogy here. I pulled this from a website showing the distribution of the margin of victory for the home team for football games. So you can see that a team winning by 0 to 3 points occurs almost 9%, maybe 8.5%, 9% of the time. So it's just showing you how often a team wins or loses by. But now let's say that your team has a game coming up and you say, oh, I'm so confident they're going to completely destroy the opponents. I'm willing to bet that they're going to win by 45 points. Is that reasonable? Well, we just look at the history. This would be like our historic volatility, and say, how often does that happen? Well, more than 36 points is pretty rare, only about 0.5%. Winning by a lot more than this, let's say 40 or 45 points, is probably not a good guess. This is exactly how we're approaching it when we're comparing implied to historic. So how can you do that quite easily? Well, this is where your broker's platform can help. Here is E-Trade, and so we're looking at Apple right here. On their platform, if we go over to this tab that's called the Quote tab, right down here, let's go ahead and bring this up. In blue is the historic volatility of the stock, and in orange is the implied volatility. This is going to be for the at-the-money strikes. It's usually at the money plus or minus 2 strikes, but it's going to give you some type of an average. But the idea is, look at how the implied volatility was really ramping up here and then starting to fall over. Well, this was coming into the earnings, which were end of January. I think it was January 28th. And so market participants were willing to pay a lot more for those options. And now that the news is out, it's starting to fall. So back on this date here before the earnings, you could say that the market was implying, upwards of getting close to 30% when the stock was only delivering about 15%. So this would give you a good indication that these options were very highly priced, regardless of what the dollar amount was. You can't look and say, oh, it's only a $3 option, it's cheap. Instead, we always have to view it by the implied volatility compared to the historic. Now there's another comparison that you should also learn to do, and that is to look at the implied versus the implied. Compare those together. Why? Well, some options always trade at high volatilities. It's what we call some very high risk premiums that are in there. And so just because it might be trading at a volatility higher than the stock's historic volatility doesn't necessarily mean it's a bad deal. In other words, what we have to do is to compare to see if they're relatively high or low. And so to do this, we might want to check implied to implied. How do you do that? Well, again, we can come back to our option trading platform. And in E-Trade, I'm going to go back to the Options tab right here. And right down here in this little icon, that's allowing me to compare the implied volatility. See right here in this legend, the solid purple line is the implied volatility versus the 30-day average. So I can see when the implied volatility is relatively high or low, depending on the various expirations that I might be looking at. And you can get some wonderful insights from looking at implied compared to implied, regardless of whether you're looking for short-term or long-term strategies. So if you're new to options, make sure before you buy the option, no matter how cheap the option might seem in terms of dollars, check that implied volatility to the historic volatility, and then check the implied volatility to the implied volatility, and you'll be on your way to making better decisions. If you'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and strategy lab at optionsa2z.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.